I want to show you something a little crazy as far as how much Newell crap I actually own. So what I got here, I got like 5 of these. These are Yankee candles. You can't really see it that well. I got a Sunbeam mixer from like 1990. I got a Contigo little water bottle. I got a Mr. Coffee. It's like holding up all my markers here. I got some Elmer's glue. I got tons and tons and tons and tons of Sharpies. Something that's not here, I got like a Marmot jacket. Like, I got like 3 of them. I definitely have 3 of them somewhere in the house, and I just can't find them. I also just threw away a Coleman cooler just yesterday. Damn, Newell, you owe me freaking money. I own so much crap from you guys. So the reason why I wanted to show you is because I think it's pretty interesting to think about, right? Here's this huge company where so many U.S. households, they have Newell branded goods, and yet at the same time, the stock is just being crushed and hammered. So I think it's an interesting value opportunity to talk about. So let's unpack that. Okay, so let's talk about Newell Brands, ticker symbol NWL. And so Newell Brands is a consumer products company with leading brands in each of its respective markets. So it usually occupies the number 1 or the number 2 market share position here in the United States. So like I just kind of walked through in the intro, think Elmer's Glue, Sharpie, Coleman's, Mr. Coffee, Marmot, and a slew of other brands that are in so many U.S. households. Newell is essentially a recapitalization play. So what I mean by that, its mix of equity and debt is dramatically changing, largely due to its $9 billion after-tax divestiture program. So it's going to take those proceeds after selling large swaths of this business. It's going to generate $9 billion in after-tax proceeds, and then devote part of that, so about $4 billion, into paying down debt, and then the remaining $5 billion balance to most likely towards a capital return program via a share buyback. And so, yet despite this kind of development, investor confidence in the company has waned pretty dramatically over the last year. So the stock price is currently trading about 50% off of its 52-week high of about $29 to $30 per share. So it's kind of trading in that $15 and change range right now. And part of that, or a lot of that, has to do with a lot of headline risk, a lot of negative news that's kind of swirling around the company. Firstly, the company's kind of been missing earnings and sales expectations. There's been a lot of poor communication, in my view, on part of management to the investment community, specifically around future economic targets. There's been quite a bit of unclear accounting around the company, so the company has continued to restate its financials. And lastly, and kind of most shockingly, top management has been rotating out of the company. So it's kind of signals to the investment community that there may be a lack of cohesiveness between the executive management team and the board. And so those are kind of negative signals for the investment community. Yet, arguably, interestingly enough, therein lies the enormous opportunity in this particular company. So you have a lot of this headline risk, and it's kind of, you have these rain clouds over the company, but post transaction, post all of the dust settling, I think what you have is a really, really sound company. So with the company's divestiture program pretty much more than halfway through, with the remaining, so they've already done about $5 billion in transactions, and you have about $4 billion on the way, which is anticipated to be completed by year-end 2019. what you have, what remains in the aftermath is, like I said, a really interesting and sound business. So the reason why I believe that to be the case is because you actually have a business with, like I said, market-leading brands that generates returns on capital of 30%. And that shouldn't be brushed aside too lightly, because not too many businesses can generate 30% returns on invested capital. That's actually quite an exceptional number. So what are these near-term headwinds? So some of these near-term headwinds involve, China tariffs, currency headwinds, relatively recent liquidation of Toys R Us, and the consolidation of some of Newell's retail channel, distribution channel partners, among other factors. These kind of developments have been weighing on the underlying operating and economic performance of the company and on the stock valuation overall. But in my view, if you were to really think about these line items or these risks, they're quite temporary in nature. So once all the dust settles, I think what you have is a very sound and a very compelling business with these really powerful brands. So based on three valuation methodologies, a discounted cash flow, or short DCF, utilizing a 9% discount rate, peer group comparables, so a basket of peer consumer product companies, and in addition to that, if you were to apply the takeout multiples that Newell's been able to garner on its divested businesses, if you were to apply those multiples on the wider organization, kind of just thinking through all three of those valuation methodologies and where the valuations kind of end up, you get an intrinsic value range of about $28 to $40 per share in my estimation. So that compares again to where current market prices are trading at as of the date of this recording of $15.30 per share. So that kind of gives you an implied upside range of somewhere between 83 to 116% upside in my view, and based on my estimates. So quite an interesting play. Now, one thing about the upper range of the estimated intrinsic value range, it pretty much assumes more optimistic normalized earnings and profitability expectations for the company. And so that's how you get to the $40, probably the $38 to $40 per share range. Also, if you were to kind of just cross-check that valuation, if you were to consider where the company was valued at year-end 2017, which is pretty much right before or right around the time, calendar year-end 2017, the company was trading at about roughly on $24.6 billion, including debt. So on an enterprise value basis, it was valued at $24.6 billion. Now, if you were to subtract out the $9 billion divestiture program, okay, the assets are going to shrink from $24.6 billion to about $15.6 billion. So that should be the asset value of what remains. Now, we know that with that $9 billion, the company is going to devote $4 billion to debt paydown, $5 billion to capital return. So if you were to consider where the debt position was at year-end 2017 and where it's anticipated to be, you're gonna go from about $10.5 billion in debt to about $6.5 billion in debt. And in addition to that, with $5 billion in capital return, the company could, in my estimation, decrease the share count from 2017 year end to going forward into the future by about 42%. So you should see shares outstanding, go from about roughly around 488 million to about 281.7 million, somewhere around that ballpark. And so you're going to have a pretty significant decline in the shares outstanding. So that implies more earnings accretion on a per share basis. And so if you were to kind of reverse engineer the math, at least insofar as what the implied equity value of this company should be, if the whole asset was trading at 15.6 billion, you have 15.6 billion minus the 6.5, that leaves you about a market capitalization of 9.1 billion. And now if you have a market capitalization of 9.1 billion, divide that by the new anticipated share count, which you should have after the $5 billion have been utilized to buy back shares, you get a share price of about $32 per share, which is kind of right in the intrinsic value range of where I think the company should trade. So again, that compares with where the share price of this company is currently trading at around $15.30 per share. That's quite a bit of upside and quite a bit of margin of safety in my view. Lastly, if you were to consider what CEO Michael Polk stated on the third quarter 2017 earnings conference call, I want you to, it's kind of encouraging to hear what he said. So let me just read that for you real quick. So Michael Polk stated at $16, $17, $18 a share, we're deep value right now. So this is a sale of a lifetime, which is exciting in some ways. When we did our original work and thought about where our share price was going to be when the proceeds became available, we weren't ever envisioning a $16 a share or $17 a share or $18 a share price. So that's kind of interesting and encouraging to think about regarding this particular company, and kind of gives you a little context where I think where management believes the intrinsic value ought to be. I think that implies that even management thought the intrinsic value ought to be way north of where it's currently trading at. But with all of that being said, there is no sure thing. And I want to highlight the risks because I think it's a responsible thing to do whenever you're discussing a particular stock that you're interested in discussing or examining. And the risks are real. They're quite, they should be considered very seriously. So some of these risks is the fact that CEO Michael Polk, who just made that quote about the share price being relatively low, he's currently, it just recently came out on March 14, 2019, that he'll be stepping down from his role as CEO come the end of second quarter 2019. So that kind of gives you a picture, again, like I said, of, it signals, is there really a deep level of cohesion between the management team and the board of directors? And that kind of could shed some light on the future or the near to intermediate term prospects around some of the strategic changes that are going to occur at the company. So in addition to that, China, U.S. relations with China, and specifically regarding tariffs, is a pretty material concern to be on top of. I think in 2019, the company's already anticipating, due to the tariffs, they're already anticipating $100 million in operating margin headwind. So profitability-wise, you have a $100 million headwind due to these tariffs. Now, in addition to that, other risks also involve if certain retail trade partners, like say Staples or Office Depot, undergo further consolidation, or if they undergo bankruptcy, that could meaningfully hurt the business and therefore profitability, and therefore in turn valuations of the company. Also, another risk is if the company, so like I said before, the company still has about $4 billion in divestiture proceeds that are anticipated to flow through. If the company doesn't execute on selling the remaining balance of its assets, that could materially change valuation estimates. So that is a real concern, because originally when the company announced its divestiture plan, its updated divestiture plan, known as the Accelerated Transformation Plan, when the company announced it, they were anticipating $10 billion in after-tax proceeds. But since that time, when they first announced that in early 2018, they've had to update that and decrease it by 10%. So instead of $10 billion, they're now anticipating $9 billion. And so that kind of should signal to people that there is a chance that the company may not be able to divest or successfully divest the remaining $4 billion in their divestiture program. And lastly, I think this is more of a macro risk. I think the very fact that we are in a 10-year, I think nearly a 10-year bull run, should signal to investors that, okay, how much more how much more runway do we have? In addition to that, with I'm not sure if it's still the case today, but we recently had a scenario where we were in a flattening yield curve environment, which should signal that a recession could possibly be on the horizon, especially if it were to invert. I think that's kind of an interesting or a scary development that could occur. And now with Newell Brands top line sales tracking where United States GDP growth is performing, if the United States economy were to undergo a downturn, that could obviously have negative implications on the stock. So these are some risks that you have to consider, especially when you're thinking about investing in a specific stock as an active investor. So I definitely want to highlight those to you at first, and for you to be aware of those things. And so as you kind of do your own fundamental analysis and your own research, be aware of the risks of the stocks that you're involved with. Okay, so here is kind of the background story regarding Newell. So I think I want to rewind the clock back to 2016. So 2016, Newell underwent a dramatic change where it acquired Jarden Corporation for about $13.2 billion. So this compared with Newell's total asset value or enterprise value at year-end 2015 about $13.9 billion. So while the transaction more than doubled sales, Newell actually continued to miss earnings targets thereafter. And so the transaction wasn't necessarily all that management thought it would be at the onset. And in addition to that, the company dramatically overextended its balance sheet. So it quadrupled its debt and it increased its share count by about 80%. So it diluted share count in a really meaningful way. So in addition to that, like I said, according to the Wall Street Journal, in the ensuing years, the company continued to miss revenue targets in the wake of this major acquisition. So fast forward to the fourth quarter 2017 earnings conference call, and management comes out with its transformation plan. The transformation plan where it wanted to divest about $6 billion in assets and return the company back to the profitability levels of where it used to be prior to the transaction, and kind of simplify the organization of the company such that it can return to that profitability level, and then return part of that $6 billion in proceeds to shareholders, and also to de-lever the balance sheet. Okay, so come early 2018, around the March timeframe, what you have is an interesting scenario where a very famous investor by the name of Carl Icahn gets involved with Newell Brands. He discloses through what's called a Form or a 13D filing that he has a 7% interest in the company. Shortly thereafter, management comes out with what's called an accelerated transformation plan, which is the updated transformation plan, where they're indicating that they want to now pursue $10 billion in asset divestitures versus the previous $6 billion. Keep in mind that $10 billion was later on adjusted down to $9 billion. And that accelerated divestiture plan was largely due to the fact that Carl Icahn got involved. Now, subsequent to that occurring, Carl Icahn actually did in fact increase his stake in the company from 7% up to 10%, as the stock price was going down throughout the year. And the stock price was, as I said earlier, was going down largely due to a lot of headline risk, a lot of negative news. And so, in addition to that, along the way, Carl Icahn pretty much garnered 5 out of 12 board seats. So it kind of gives you a little picture of how much skin he has in the game, and how invested he is in this particular company. And I think it's interesting to consider and think about, because he is a very famous and successful investor, and I think it's an incremental positive to be on the same side in terms of the bet or investment as a renowned investor like Carl Icahn. And so if you were to kind of just read between the lines insofar as what management is trying to do with the company, it looks like they're trying to reverse engineer the Newell acquisition of Jarden Corporation back in 2016. So it looks largely because they're separating huge swaths of the business, these non-core assets, and they're deleveraging the balance sheet, and they're buying back shares. So they're reducing the share count. And so it looks like they want to get back to where they were, at least from a profitability standpoint and from a capital structure standpoint, where they were back in 2015. And if they are successful in achieving that, I just want to highlight that at year-end 2015, Newell stock closed out the year at about $41 per share. So it's kind of interesting to consider, especially if the management team is successful in achieving the full extent of how profitable this company can be and where it can return to. Okay, so now let's dive into kind of the research process. How do I stumble into this particular opportunity? How did I think about this stock? And how did this idea come about? And so, and part of this section is really more towards the newer folks to investing, and I kind of want you to walk through how particular ideas you can stumble across them. So the way I kind of found out about this particular opportunity wasn't through a stock screener, like I talk about in my earlier podcast episodes, but I came upon it through reading the Wall Street Journal. And so in one of their earlier articles, I think in November or October of last year, they were talking about how Newell was pursuing this $10 billion asset divestiture program. When I saw that number, $10 billion, I knew that's not a small chunk of change. So I immediately, the next thing I wanted to do was check how big is the company, meaning like how on an enterprise value and a market capitalization basis, how big is this company and how big is this asset divestiture program relative to the size of the company? Because if it was meaningful enough, then the company and the management team can do pretty interesting things with the capital structure and probably return a lot of value back to shareholders. And so I did a quick search on Yahoo Finance. I know the statistics on Yahoo Finance may not necessarily be the most accurate, but it's just kind of a rough proxy for me to gauge, okay, how meaningful is this thing? So I immediately realized that at the time, the company had at around November, December of last year, the company had a market capitalization, or rather an enterprise value of about $15 billion and a market capitalization of around $9 billion. So that implied a net debt position of $6 billion. So here's $6 billion in net debt. Here's $9 billion in proceeds that could be generated from the sale of parts of this business. So you have $9 billion in cash coming in. You have $6 billion in net debt. You could wipe off all the debts of the company. And if that were to be the case, and still have some cash left over, and if that were to be the case, your market value would trade in tandem with where the enterprise value is. So you could kind of theoretically presuppose and make that leap and assume that if the market capitalization is $9 billion, I wipe out all the debt, I could be trading at an enterprise value. I could have the market capitalization trade in tandem or in line with where the enterprise value is at $15 billion. That's quite an interesting scenario. So those were just some hypothetical leaps that I had made while thinking through and reading the article and looking this up on Yahoo Finance. I didn't know what the company was going to do with the cash. So that wasn't the end-all be-all to my research. I started asking, I realized that it's worthwhile to ask more questions and to dig and pull the strings. And so the next place for me to go was, what is this whole program about? What does management intend to do with the cash? And so the next place for me was to look at the investor relations page, because most likely, oftentimes, management teams that have investor relations desks, they actually, they put together investor presentation slides and kind of show you what the intent of management is. So I went quickly to Newell Brand's investor relations page, pulled up all the presentation slides, pulled up the earnings releases related to the company over the last year, and I just started kind of immersing myself and reading into what this whole accelerated transformation, or ATP plan is all about. And so, the next logical place to go, let me backtrack a little bit there. But so along the way, I realized, okay, they're going to take $10 billion at the time, which again, like I said, is updated to $9 billion now. They were going to devote about 45% of it to debt pay down, 55% of it to share buybacks. That's very meaningful, very, very meaningful. And so I wanted to learn more. Well, where do you go to get more information on the company? You have to go to the SEC, and you have to pull up a lot of documentation that's going to be necessary for you to make an informed decision and for you to kind of put the mosaic of this company together to arrive at what is the whole picture of this company look like. And so the place to go is SEC Edgar. It's a public database where publicly traded companies have to disclose all material information to their investor base. So I pulled up the 8Ks, 10Qs, 10Ks, 13D filings, 13D filings for Carl Icahn, why he got involved and whatnot, and what price points he got involved. And so, just a little caveat, Carl Icahn, at the initial onset, he got involved at $26 per share. And then later on through the year, he started buying more as the stock started declining. And I think the most recent 13D adjusted filing, he got involved at $20.50 a share. That kind of gives you a picture of at what price points he's willing to buy into relative to where the stock price is at right now. I'm not telling you to get involved, but I'm just saying that the stock price is below where Carl Icahn is willing to get involved. So I think that's kind of informative or signals to us like where he thinks probably intrinsic value is. So anyways, let me just circle back to kind of how I thought about an approach to research process. So I pulled up all the filings, and so the 8Ks are all material new information that the company discloses. And so it can be a lot of things, but occasionally some of the 8Ks involves earnings releases. So I read those, I read the earnings transcripts, and I immersed myself into the financial picture of this company, and I used the data from all of these filings to build a financial model. I kind of established the historical picture of what this company looked like, I think from 2012 to 2017, and then built out my future projections out into, I think, like 2022 and 2023, and then I kind of figured out what the normalized earnings expectations are. So I pretty much figured out that this past decade, maybe 2011 to 2016-ish, was their peak performance time. They were generating operating margins of I think like north of around 13 to 14%. I think they peaked at around like 15% operating margins, and that's where valuations were very, very high. And then post-transaction with Jordan Corporation, you have a situation where management kind of bit off too much, more than they could chew, and they're in the situation they're trying to reverse engineer everything. And now I think based on where, essentially where the company could return to based on a normalized earnings expectation and assigning the valuation of where the company ought to be based on normalized earnings, I kind of arrived at my valuation range, which was about $28 to $40 per share. How did I do that? Well, I built the financial model. How did I build the financial model? It came from the 10K, 10Q earnings releases, transcripts, company guidance. Guidance is where a company, the management team kind of projects out what they anticipate they're going to be achieving. They don't always hit those targets, but it's, again, guidance. And so it kind of gives you a picture of where the company could be or where it could likely be. Again, they don't always hit those guidance targets. So that's kind of how I approached Newell Brands. And so, yeah, hopefully this was helpful to you. I'm going to make this financial model, the financial model that I built and the valuation work behind it, or that I extrapolated from the financial model. I'm going to make it public to you guys. It's totally free. It's for educational purposes only. I'm not going to update this financial model for future use. It's just there for you to kind of tinker with, look at the assumptions, and kind of get more familiarized with looking at a financial model and interpreting the information that's on there. And so I just wanted to throw that out for you. I put the link to the financial model in the bottom below. If you think that this, I hope it's been useful for you guys, but if it has been useful for you guys, I hope that you, leave a comment, give me some encouragement, give me a like, subscribe, tell your friends out there that this resource is out there for you guys to take advantage of. And this is all going to be, the content is also available on podcasts, wherever you get your podcasts from. And so, let me know what you think. Let me know if you disagree with this particular opportunity. And so let's talk about it. All right. Okay. I'll talk to you guys later.